Okay. Yeah. Thank you very much. Welcome everybody to the International Economic Association's 19th World Congress. And I've said this before, we all regret yesterday the Finance Minister Shrimulyani was here, all regretting that a conference in Bali is very different from a virtual conference in Bali. But given the state of the world, we have no choice in this matter. Before we introduce the speaker, Joe Stiglitz, who is here, I will introduce him and start his keynote address. We want to recognize the 5 award winners of the Joseph Stiglitz Essay Prize Award given at every World Congress to graduate students, 3 graduate students, and 2 undergraduate students. Fortunately, we have Joe Stiglitz with us here for the occasion of this naming of the winners. And we have also from the Economic Society of Australia, representing the Economic Society of Australia, Professor Danielle Woods is with us. And I'm hoping she will also congratulate you at the end of this. Let me, without any further ado, just mention that there are 2 categories, the graduate and undergraduate. The winner gets $1,000 and the others get $500. And usually we bring them over to the place of the World Congress to meet with the large number of participants who descend from all over the world, but that is of course not possible this year. So the 2 categories are graduate and undergraduate. In the graduate category, we have with us here Nicolas Longuet Marx from Columbia University. He gets the first prize. We also have with us Abdul Mumin Ahmed, who gets the second prize from the University of Glasgow. And just joined us, Wanafong Durong Kaveroj, Australian National University, gets the 3rd prize. This is the graduate category. And in the undergraduate category, we have Daksh Walia from Ashoka University with the 1st prize. And we have Pradni Kantak winning the 2nd prize from Ferguson College. Congratulations to all of you. Let me just pass it on to Joe Stiglitz to congratulate you, and then to Danielle Wood to congratulate you, and then we will move on. Joe.
Well, I congratulate you, including somebody from my own university. I had nothing to do with the choice, so it was no favoritism. It was, and I'm so pleased about the Australian Economic Society for supporting this. It began with the initiative when I was president of the IEA, and we had a World Congress, and with the generous support of Australia. And I believe there were some excess funds, and they decided to use those funds to endow this kind of prize every year to recognize some of the best young research going on in economics. So these are very competitive, and you are all very deserving of this award. And I think it symbolizes the potential future that you have in economics.
Thank you, Joe. Danielle, would you like to say something?
I would absolutely like to add my congratulations to Joe's there. The Economic Society of Australia is very proud to be associated with these awards. And it's just wonderful to see all of your fantastic contributions on 2 very significant topics, inequality and the macroeconomic settings. So congratulations to all of you, and I look forward to seeing where you go next.
Yes, and from my side, congratulations. Since I was involved in the process, I know that essays had poured in from all over the world. So it's a terrific achievement and speaks well to the future and what you can contribute to society and the world. Congratulations once again. If you want to say a sentence each, we are short of time. We will be moving over. If you want to say anything, you're most welcome. You have to unmute and... Okay, I will not burden you with that. Yeah, there are lots of people watching. I can see on the screen over here now. But then once again, congratulations. You're welcome to stay on here. We are moving over to the keynote address by the person in whose name the award has been instituted, Professor Joe Stiglitz. So stay on here. Let me introduce Joe, and then Joe, you will take over. Friends, it gives me great pleasure to introduce Professor Joe Stiglitz to give this address on development and macroeconomic policy in a post-neoliberal world. Joe Stiglitz is university professor at Columbia University. He won the Nobel Prize for Economics in 2001. He was chief economist of the World Bank. He was the chairman of the President's Council of Economic Advisors. This was during Bill Clinton's presidency. I have to say, these are all achievements that are well known. At a personal level, I have to say there are two qualities of Joe which for me have been very, very important. One is as a researcher. He's one of the most creative researchers in the profession, and a person, and I don't use the word creative lightly. It's a strange ability to stare at the world and discover patterns, discover unusual connections. His whole range of papers reflect this amazing quality, which to me is the finest quality of a researcher. Number two, Joe Stiglitz embodies values, progressive values, values for justice and equity, which are so important in today's world. So with these few words, let me not take up any more time and call Joe Stiglitz to do his presentation. Joe, the floor is yours. And I'm hoping you can write down your questions on chat. And time is limited, I know already from from the start of the conference, but I hope I'll be able to pick up on a couple of those chat questions and give them to Joe at the end of his talk. Joe, the floor is yours.
Well, thank you very much. Whoever is controlling it, I need to do some screen sharing. Is that possible?
Ola, you'll have to make him co-host. Let me...
let me see if I can do it. If I can do it. Yes, great.
Okay.
Great. Thank you very much. And let me great. Okay. So what I'm going to talk about is development and macroeconomic policy in a post-neoliberal world. There have been a lot of changes in economic philosophy, you might say, in the last few years. The 2008 crisis, the pandemic, a host of other events have led us to rethink a lot about what our standard understandings of economic policy. And we've come to reflect that, in fact, that for the past 40 years, economic policy has been dominated by a particular set of doctrines that for brevity I'll call neoliberalism. There are a variety of names you could give to it, but I think that's a simple word that summarizes a lot of the doctrines. These doctrines emphasize the key role of markets, stripping back the role of the state, for the most part, not totally, ignore the role of society, and a variety of other institutional arrangements like cooperatives and not-for-profits. Some of these are very important. Both Kaushik and I and many others teach at universities. Most of the most successful universities in America are foundations that are neither for profit nor government. They're a different institutional arrangement and have an enormous impact on our society. So that's the institutional aspect of neoliberalism. In terms of what it focused on efficiency, implicitly assuming the distributional concerns could be addressed through political processes. Underlying this was a theorem, the second fundamental theorem of welfare economics, which said, of course, that any distribution that you wanted could be achieved through lump sum redistributions. But there were very stringent assumptions for the second fundamental theorem of welfare economics. And of course, we know that most importantly, lump sum taxes don't exist. And underlying it all was the most important idea in modern economics, that of Adam Smith, the invisible hand, the pursuit of self-interest led as if by an invisible hand to the well-being of society. That is the presumption that markets are efficient, invoking the first fundamental theorem of welfare economics. These set of ideas were the cornerstone of policy. And just to reflect on that in the context of the subjects I'm going to be talking about today, in development, it led to a set of ideas called the Washington census doctrines. Though more careful policymakers noted there were no grounds in standard theory for one of the doctrines that was often pushed, that is capital market liberalization. And that was true about many of the other aspects of it. They were policies that were extrapolated from the standard theorems, but not actually justified by those theorems. And then again, more careful policymakers, like Adam Smith himself, recognized that government had to play an important role in many areas, for instance, in education. Another area where neoliberalism was particularly influential was in globalization, in the determination of international economic policy. The global agreements that we see around the world, WTO, were really shaped by neoliberalism. And the third area I'm going to talk about is in macroeconomics. And here, there were a simple set of precepts that if only government kept deficits and debt low and monetary authorities kept inflation low, below 2%, markets would take care of the rest. And there were many other, you might say, sub-doctrines. For instance, they argued for independent central banks, focusing on inflation, often using inflation targeting. Well, the promise of neoliberalism, the reason it was so influential was that it promised to deliver higher output, faster growth. Everybody would be better off. Yes, some people might do better, but the pie would be so much increased that even those at the bottom would benefit. With some variant or another of trickle-down economics. And it also promised greater stability. It focused on price stability, but the promise was that price stability would lead to greater real stability. Well, none of these promises were really delivered. That is the disappointment of neoliberalism. That is a disappointment that has become more and more apparent 40 years after, you might say, the triumph of neoliberalism, and 30 years after the real victory of the market economy over communism with the fall of the Berlin Wall. You have to put in context, a historical context, how long neoliberalism triumphed. You know, the history of capitalism can be thought of as maybe 220, 250 years. So 40 years is a significant fraction of the history of capitalism. So under the history of modern capitalism, this set of ideas is really a set of ideas that had sway for a significant period of time. What we've seen is There was a lower growth rate than in the era before neoliberalism. The fruits of the growth went to a small number at the top. There was greater income and wealth inequality. There was stagnation at the bottom. The United States is perhaps the most emblematic of that, where real wages at the bottom are the same today as they were 65 years ago, before the beginning of neoliberalism. They're giving rise to what's often called the inequality crisis. We've seen instability, unprecedented levels of instability, whereas in the 40, 50 years before neoliberalism, there was not a major financial crisis. In the 50 years, 40 years since neoliberalism, there have been dozens of crises, the most serious of which is the 2008 crisis. Not only has it not produced what it should have done, it hasn't dealt with emerging crises, the climate crisis, and in some countries and some sectors, a host of other problems. In the United States, we have the opioid crisis, the crisis in childhood diabetes, a host of other examples of exploitation caused by the market. The social media opened up a new era of viral misinformation, disinformation, with severe political consequences. And the result of all these failures is erosion of political support for certain aspects of neoliberalism, especially those associated with globalization, which I'll come to in a little while. So contrary to Francis Fukuyama's famous book about the end of history, that all countries were converging to liberal democracies and free market economies, today, the failure of neoliberalism has split the world into authoritarian regimes and those with stronger democracies. So we are not converging, we are diverging. So what I want to do in the remaining limited amount of time is spend some minutes talking about how do we account for those failures, and most importantly, where do we go from here? So accounting for the failures, even as neoliberalism became the dominant dogma in economics, the intellectual underpinnings were being taken away. It was a kind of irony that it triumphed just when economic science was explaining what was wrong with these very ideas. One area where I played an important role was the economics of information. The result in a theorem that I did with Bruce Greenwald, which is with imperfect and asymmetric information and an incomplete set of risk markets, even competitive markets were not constrained Pareto optimal. In other words, the reason the invisible hand was invisible was it wasn't there. And in general, markets were not efficient. There were government interventions which could make everybody better off. At the same time, game theory and other advances in the theory of imperfect information highlighted the importance of these imperfections and suggested, quite contrary to what is sometimes called Chicago economics, the natural state of the economy was best described by high levels of market power and imperfections and competition. And finally, behavioral economics undermined one of the basic aspects of that standard model, the rational actor with well-defined preferences, maximizing his utility. That there are two strands of this work. The early strands, beginning with the work of Kahneman and Tversky, and then amplified by people like Taylor, both all got the Nobel Prize, emphasizing cognitive limitations and how in the presence of those cognitive limitations, where you have to think fast, for instance, psychology, the insights of a sister discipline of psychology were often more predictive of behavior than the insights of economics. People were predictably irrational. But a more recent set of paper I've engaged with Carla Hoff and highlighted by the World Bank WDR in 2015 emphasized the endogeneity of preferences and social determination preferences. And all of these were really marked departures from the paradigm that prevailed at the time that neoliberalism arose. One of the underlying hypotheses that markets are efficient is that there are no externalities, or at least they're not that significant. But one of the things that we have confronted in the late 20th and 21st century is the pervasiveness of externalities. These are not second order, these are first order, with first order consequences for our society. One has to begin, of course, with thinking about climate change, the environment. It's an existential matter, and clearly the market cannot handle that alone. And then there are a whole set of macroeconomic externalities that are a reflection of the microeconomic externalities that Greenwell and I called attention to. Examples of that are those associated with excessive risk-taking by banks or with excessive foreign-denominated borrowing by firms that Anton Cornell has emphasized. And then there are the externalities associated with inequality. Here, the research at the IMF marked different from the IMF that I was involved in some of my battles when I was chief economist of the World Bank, emphasized that societies with less inequality perform better. That's an example of a macroeconomic externality. Some of this is explained by agency costs and inefficiency associated with delegation, that is, and the magnitude of which can be affected by the magnitudes of inequalities in our society. But it's also associated with imperfections of capital markets. Those with limited ability can't get the education that they need to live up to their potential. And it reflects the fact that much of inequality arises from market distortions, from rent seeking, from the market exploitation of market power, exploitation of market vulnerability. Many of those reflected in the crises that I identified before, like the opioid crisis and the childhood diabetes crisis. One of the important changes in perspective today, and I think it will help define the research agenda going forward, is that earlier the research agenda involved beginning with the competitive market as the basic benchmark, and then talking about deviations from that. It's not clear that that provides a good baseline benchmark description of the economy. And we are increasingly aware of the pervasiveness of market power and exploitation. For instance, that market power and exploitation, I believe, provides a better explanation of inequalities. Since the beginning of modern capitalism, there's been a debate about a conflict between two different theories of inequality. Is it a result of market power, exploitation on the one hand, or is it a result of the fact that some individuals have assets, endowments, and make more contributions to society? The neoclassical theory, sometimes called the just desserts theory. And when we look at the people at the top of the wealth and income distribution, it's clear that while some of them have made major social contributions, much of their wealth is a result of market power and exploitation, some of which they leverage off of their original contribution. But others have made actually no major contribution, have just used market power. And at the same time, if we list the people who made real social contributions, the discoverer of DNA, mRNA, that saved us from help provide the basis of the vaccine that saved us from COVID-19, those typically are not among the wealthiest in our society. So you cannot say that distribution of wealth reflects well the distribution of social contributions. Market power evidence is that it increasingly, as evident in particularly the American economy, and plays an important role in explaining the distribution of income and wealth. And that market power has been exacerbated by new technologies, for instance, network externalities. But I also want to highlight the innovation in exploiting market power. For instance, new contract provisions that are a standard part of the contracts of financial intermediaries, of the world's global airline distribution systems. Microsoft engaged in those, a whole host of things, you might say innovations, but innovations not to increase societal welfare, but to increase market power. And an example of that, of increasing concern, is the role of AI, doing a better job of extracting consumer surplus, allowing for differential pricing to different individuals, and thereby undermining the basic principles which underlie the first welfare theorem. So in a sense, the innovations are actually undermining the theory that pro-market economists had once before. Finally, one of the things that we've come to recognize is the importance of rules and institutions. Markets don't exist in a vacuum. They're governed by rules, regulations, and institutions. And these rules have implications for efficiency and distribution. I want to highlight that there is going to be a special session of the IEA on precisely these issues later on. These rules, because they have distributive effects, mean that there is a distributive battle in which power matters. And if we look through every one of the laws in our society, almost all of them have distributive consequences. And if you study carefully what is going on, for instance, in the United States Supreme Court, the decisions in economics that it makes, they're all about distributive battles. And the division 6-3 are basically 6 conservatives trying to enhance the market power, and the other 3 trying to limit market power. There are labor laws weakening unions and workers' bargaining power, antitrust laws limiting or not limiting firms' market power, corporate governance laws limiting or not managerial power, and globalization rules affecting how gains from trade are shared. The concern is that current rules may make workers worse off. That what has happened in the United States, particularly over the last 40 years under neoliberalism, is that the rules have changed to the disadvantage of labor relative to capital. So that leads us to the next agenda. How do we reconstruct economics in the post-neoliberal world? And then after that, the final topic I'm going to talk about is how does that lead us to new policy frameworks? So I'm just going to hint at some of the elements of this, but in reconstructing economics, we begin with the nature of the human being. After all, social sciences are about people and their interaction with each other. The objective of economics, I believe, is to enhance the well-being of individuals. That's the core unit that we want to focus on. And the model of the human being that is at the core of neoliberal economics is basically wrong. We have to recognize cognitive limitations, only limited rationality, and their preferences are endogenous and shaped by our parents and by our society. All that may seem obvious, but actually has profound implications. For instance, when we look at the smallest unit of the household, there's a family, but not everybody in the family is treated the same. And there's an important element of development in economics about the bargaining power, the sharing of income and wealth within the family. Now, if you go from that, the one unit, the household, to the other unit, the nature of the firm, again, we see that the nature of the firm is very different from that in the neoliberal model. It's not necessarily profit maximizing. We've gone from shareholder capitalism to stakeholder capitalism. Some of the early work that I did with Sandy Grossman showed that the shareholder capitalism was not theoretically defensible, even though Milton Friedman, as a great polemicist, has successfully argued that and had an enormous influence in shaping the laws, corporate governance laws around the United States. Fortunately, he was less successful in Europe. Another aspect of the nature of the firm that's gotten a lot more attention is that in the work of the first fundamental theorem of welfare economics, top technology was taken as exogenous. But what is really important is that technology is endogenous. And it's not clear whether the market forces shape technology in a way that is in the interest of society. In fact, it's quite clear that it doesn't do that. We have less efforts devoted to saving the planet than we should, and more efforts to replacing unskilled labor where there's already too much unemployment with robots. And then thirdly, we need to rethink the nature of markets and economic interactions. I already emphasized that the importance of the imperfections of competition, imperfections of information, the importance of rules set by the government. But the fact that rules are set by the government and play such an important role in turn means that economics and politics can't be separated. We have to think about laws, societal norms, and so forth. And that leads me to what has been a theme in much of my work in recent years, is that what is critical is a better balance between markets, government, and other institutions. And that emphasizes the importance of collective action. Now, collective action is obviously important in the context of inequalities, externalities that I mentioned before, but I also want to emphasize the importance of the provision of public goods. The most important among the most important public goods, of course, is knowledge. The reason that we have a higher standard of living today than we did 250 years ago is because of the advances in science. Basic research is a public good which will be undersupplied by the market. So if we want rapid innovation, we have to have a strong government providing for strong public investment. And that was the theme of the book I wrote with Bruce Greenwald called Creating a Learning Society. This in turn, the importance of innovation means that there's going to be constant change in society. There's going to be constant evolution in response to changes in technology, also in preferences, and also as we learn from mistakes. And the implication of this is the equilibrium models, which have dominated economics since the time of Ballrausch, are of only limited value. Neoliberalism was a powerful ideology. And one of the things I hope is that we will learn the lessons from its failures. And this talk is an attempt to learn some of the lessons from the failures of neoliberalism by deconstructing why it failed, and hopefully on the basis of that, constructing a way forward. So let me now, in the last few minutes, talk about the policy implications of this for macroeconomics, for globalization, and for development. In terms of macroeconomics after neoliberalism, the key here is to go beyond DSGE models. And the key word I would put here is the E, the equilibrium. Yes, obviously we want models that are dynamic. Yes, we want models that are stochastic, that recognize variability. Yes, we want models that are general equilibrium, that look at all the interactions, but no, the big perturbations to our economy are not equilibrium perturbations. The 2008 perturbation, the pandemic, these are not equilibrium events. And it is absurd to think that after a perturbation of those nature, we go automatically back to some equilibrium trajectory. In fact, one of the major failures of DSGE is that there is absolutely no theory about how the economy attains the new equilibrium. So here on the slide, I say there are many critical flaws: assumption of equilibrium, no explanation of how it's attained, assumption of stationary stochastic processes. What we've seen is things are clearly non-stationary. There's lots of learning as opposed to what is the case in the stationary models. Disturbances in the standard model were exogenous. It's clear that the 2008 crisis was endogenous. And it's basically impossible to predict shocks with big effects. The pandemic, I mentioned Trump here, is a political event that changed the rules of globalization and therefore had an enormous economic effect. It was a political event, unanticipated, but with economic consequences. And the final point is really important and something I've been working on. The decentralized market adjustment processes may be disequilibrating. As I said, the core mistake of DSGE was the equilibrium. If we think of how markets actually adjust, it's a decentralized adjustment processes, and a modeling of those suggests that they may, in fact, not be stable. Fortunately, economics, even in the era of neoliberalism, was developing in a number of different directions. And so we have many of the pieces for the construction of alternative approaches. One set of ideas that I've been working on with Martin Guzman, who's now the economic minister of Argentina, is a set of theories called dynamic disequilibrium theory with noise, emphasizing that both the disequilibrium nature and its noise, emphasizing that the stochastic processes are not stationary. We have an NBR paper and a paper, a forthcoming paper on that topic. The uninsured shocks to firms in the presence of endogenously imperfect capital markets, for instance, equity rationing, gives rise to fluctuations on both demand and supply side, emphasizing that you really can't separate demand and supply. Exacerbating this is that shocks to banks lead to changes in credit availability. It's not just the interest rate. There is credit rationing, and not only credit availability, the terms on which credit is made available, but again, demand and supply effects. One interesting thing that Martin and I have been working on is that in the absence of common knowledge, where there's shared views about the probability distribution, individuals take bets if there are markets, and there are strong forces to do that. And they can be done both directly and indirectly through taking different positions in structured financial markets. And each side believes that it will win. And that gives rise to a collective belief of more wealth than there actually is, what I call pseudo wealth. And those beliefs drives consumption. And that gives rise to macroeconomic inconsistencies, because the perceptions of total wealth exceed the wealth of the economy. And those eventually get resolved, often in crises. And so we've begun to develop a general theory of why there are these kinds of perturbations and crises. And then finally, the sluggish adjustment of wages and prices, more related to risk aversion and imperfect information than the cost of adjustment, that sluggish adjustment relative to changes in the aggregate demand will give rise to unemployment. The policy implications of this should be very clear, and there's now an increasing consensus of over many of these. Fiscal policy matters and can have large multipliers. We saw that in the aftermath of the 2008 crisis, We saw that in the pandemic. And that is discredited one of the prevailing neoliberal doctrines called Ricardian equivalence. There's more focus on the country's exposure to shocks, with in turn implications for the structure of economic systems, for instance, the desirability of capital market liberalization, and correspondingly more focus on designing automatic stabilizers. These, you might say, correspondingly discrediting what are sometimes called top-down anchors, such as growth and stability pacts, limits on deficits and debts. These kinds of arbitrarily rules, and there's no economic justification for them, cannot incorporate the deep uncertainty that I described associated with that we've experienced in the last 40 years. And finally, a better understanding of the role of debt, which in the representative agent model makes absolutely no difference, but actually seems to have a big role in our theories help explain that. In terms of macroeconomic policy, monetary policy, also rethinking of that. It's provided a theory of why monetary policy is ineffective in deep downturns, not so much the zero lower bound, but of the indirect link between monetary policy and what really manages credit, difficult to induce banks to lend. And with the implication that monetary policy should not focus just on inflation. What matters is real stability, and the two are not the same. While there is a value to being able to make commitments, there is a danger of excessive constraints in a world of deep uncertainty. And that limits the value of an independent central bank. But if one is to have an independent central bank, one needs to have it more representative. Similarly, there are many implications for globalization and development. It's provided a strong critique of Washington consensus, and it's towards the Stockholm Statement consensus that Kaushik played an instrumental role in formulating a few years ago as an alternative to the Washington consensus. Today, even the IMF has joined the critique of capital market liberalization. There is evidence that trade restrictions may enhance innovation, illustrating the trade-offs between static and dynamic efficiency, and that capital market liberalization may lead to instability. And there are new development tools, sometimes less costly, and go well beyond the nudges that Sunstein and Taylor talked about, which involve changing individuals' deep preferences concerning savings, fertility, gender roles, that really do make a difference in development processes. As we think about rethinking globalization and development, one of the important aspects is the international rules governing intellectual property rights. Development is about closing the gap in knowledge, one of the things I emphasized when I was chief economist of the World Bank. And we've seen now the devastating effects of the wrong intellectual property rights in the context of COVID-19, where we would have a much larger supply of vaccines if we had not had these restrictions. And that's why there's this big movement for a vaccine waiver of intellectual property rights, with Germany leading the way in imposing impediments, the United States being on the side of more than 100 countries arguing for a vaccine waiver. And then I don't have time, but I want to emphasize the critical importance of debt management, particularly important in developing countries. The international community at the UN adopted the idea that there should be a framework, and even adopted a set of principles, but unfortunately, a relatively few credit countries have imposed, have refused to go along. And this may have some very big implications in the post-COVID-19 world, where many countries may be facing debt crises. Well, let me just conclude by saying this is, I think, a very exciting time for economics, because the prevailing models and policies based on neoliberalism have been discredited. And so there is a need to construct a new paradigm. One's not beginning from scratch. Many of the building blocks are already there, but in some critical areas, there has to be a big break from the old paradigm. The neoliberal paradigm has not served the world well, though its ascendancy may be understandable as a reaction to some of the ideas and doctrines that preceded it. So I believe that this is a great opportunity to create an alternative paradigm that can help promote societal well-being with greater inclusiveness, greater sustainability, and greater stability. Thank you. We have time for a few questions.
Yes. Thank you, Joe. Thank you very much. Lots of questions have actually come in, and I want to, time is limited, but we do want to take on a couple of them. There are questions including from the new president of the International Economic Association, which I cannot ignore, Danny, but let me begin with a question from Ittisham ul Haq. What he is asking is, what can you suggest for countries facing continuous balance of payments crises and thus having to regularly visit IMF? How to get out of this trap, keeping in mind inequality, debt burden, and economic growth in the post-neoliberal world? Thank you. That's from Ittisham. Yeah, any thought?
Very good question. Now, the international community, I think, does have both an self-interest and a moral obligation to help these countries. And we're seeing that right now in the context of COVID-19, the issuance of $650 billion of SDRs and the attempt to construct a mechanism for recycling some of the SDRs that are not being used by, say, the advanced countries to provide more money for the developing countries and emerging markets. In effect, to say, to relax their balance of payments constraints, to give them the ability to access more goods abroad, particularly aimed at investment, so they can grow out of their poverty. But in the absence of that kind of assistance, I think countries have to be very wary about getting in debt. And when they do get in debt, they have to be very sure that the money that they are borrowing is linked to investments that are, to use the word, self-liquidating, that generate enough returns that they can pay off the debt. Otherwise, there is this almost inevitability of the debt trap. And one has to remember that on both sides of the debt contract, there are perverse incentives. The lenders, particularly in the private sector, make their money from making loans, not from the developing country doing well. So there are incentives for excess lending, agency problems, and politicians have an incentive to borrow because they can give their country more, they can do well politically in the short run, but they don't necessarily have the long-term horizon. So both on the lender and the borrower side, there's short-termism. And so the institutions have to be designed to be very sensitive to these, we might call agency problems, to try to limit indebtedness.
Thank you, Joe. Danny, I don't know if you can be heard, in which case I would let you ask your question, otherwise I will read it out. Maybe I'll just read it out. Joe, this is Danny asking you, if the problem with monetary policy is excessive focus on price stability at the expense of other objectives such as employment, would you prefer that we do away with central bank independence altogether, or that we redefine the objectives of central banks that would otherwise remain independent?
Well, I think we have to redefine the objectives, and the United States does that better than, say, the European Central Bank. European Central Bank clearly has a focus on price stability. It is put as the absolute first order mandate, whereas the United States, we have a mandate where it's growth, stability, including financial stability, employment, and the central bank, even under Janet Yellen, paid attention to inequality. It wasn't a central aspect, but it certainly was aware that monetary policy is a major instrument with consequences for every aspect of the performance of the economy, including wealth inequality. And I think the low interest rates reflected itself in a growth in the value of equity, which is overwhelmingly owned by the people in the top 1% and contributed to the growth of wealth inequality. So yes, I think the first thing is a change in the mandate of that. But then the question is, when you have multiple objectives, you are going to have decision-making of how you weigh those. That becomes difficult. You have one objective, you can say it's only a technocratic thing. How do we achieve that objective? When you have many, you have to weigh them. And if you have workers, they're obviously more concerned about unemployment than bondholders, who might be more worried about inflation and the decrease in the real value of their bonds. And that's where I believe the second important thing is representativeness. That on the central bank, there have to be representatives of the various major constituents of society. Sweden has a representative labor on its central bank. There is a bill just introduced into the United States Congress to make sure that labor has a representative in the Federal Reserve. So that's important. Now, the question of independence, there is a difference between de facto and de jure. One of the great central bankers of India once told me, India does not have an officially independent central bank, but he said it was fine. If they want to fire me, let them fire me, but it will have consequences. Now, that's a case where when you had a good government, governments acted responsibly, and they took that power of expertise seriously. But then you had Modi, and he did effectively fire the central banker. And so I think some degree of independence probably may be valuable. But to again highlight the fact that these are really ambiguous concepts between de facto and de jure, Paul Volcker, one of the very good central bankers, once said, Congress created us and Congress can uncreate us. So the US is an independent central bank, but he was aware that while he was independent, he was a creation of the political process.
Joe, okay, there are lots of other questions. I thought, let me give you one from here, and let me give you first my one, be a bit selfish and throw in a thought here, which is not quite a question. I was intrigued by your comment, rather fascinated by something we know in a specific context, that there are situations where our perception of total wealth can exceed the total wealth. And you're right, this happens, as you were speaking, I was thinking in fascinating ways, not just miscalculation, but when there are multiple individuals with overlapping claims and debts, it's very easy for this to happen. I was just thinking and wanted to ask you, is there some general work you're trying to do out of this? I can see that a lot of standard explanations can be brought into the broader umbrella of a collapse in our view of what our total wealth is. We suddenly get into reality and our perception changes to reality. And it can be other way around. There can be occasions when you think your wealth is smaller and you suddenly realize that the collective wealth is bigger. Just some thoughts on what are you doing on this? And then I'll bring in one more question. There are many more.
Sure. Yeah, this is a major theme that work I've been doing with Martin Guzman on positive and negative pseudo wealth. We call it pseudo wealth just to emphasize that the aggregate collective perceptions of wealth can be greater or less than societal resource constraint. And what we wanted to emphasize is that in the presence of uncertainty and with differences in probability judgments, this is almost always going to be the case. That is to say, and it rises endogenously. If I have a different probability of an event occurring than you, then we will engage in bets, and you think you're going to win, and I think I'm going to win. And so I think I'm wealthy, you think you're wealthy because you're going to get all of my money, I'm going to get all of your money, and we consume accordingly. In the end, it is inevitable that one of us wins and one of us loses. And then we're brought back to reality. And that's sort of a metaphor, that kind of a bet for lots of things that go on in our society. Let me talk about negative pseudo wealth. I owe you money. You don't believe that I'm going to repay you. But I believe I am going to repay you. My obligation to you weighs me down so I don't consume because I know I have to repay you. But you don't consume because you don't expect to get any money from me. So that's a case of negative pseudo wealth. Now, I talk about that in these two contexts, but think about when somebody owns, when we have a structured financial product, we take a company and we divide claims on the company into equity and debt. The equity owners are the people who are optimistic. They think the company is going to do well. And the debtors are the ones who are not quite so sure. So inevitably, because the optimists, even on average, if on average, people's expectations are correct, if you sort people out to the optimists owning the equity and the pessimists owning the debt, the value of the perceived wealth is greater than the wealth. So this is actually a very generic property of finance, and we know reality will at one time or another intrude. And the basic question that we haven't answered, when it intrudes gradually, the system can adjust gradually, and we won't have a crisis. We have an adjustment. But often reality intrudes in a dramatic way. And that has to do with the way people have perceptions, I think. They suddenly realize, go back into 2008, that many of the mortgages that were written in 2008 were phony, were bad mortgages. And many of us were saying there were warnings, we were giving, things didn't make sense, but the market didn't integrate that information in a smooth way. And when that happens, there are sudden changes in societal beliefs, and that gives rise to crises where the macroeconomic inconsistencies get revealed very quickly, and that leads to changes in aggregate demand that outpace the ability of wages and prices to adjust.
Joe, let me slip in. The organizers may get worried about time. One more question. There are lots, including I can see one from my friend from years ago, Prem Chandra Atukorala. But we'll have to give it all a miss. There's one which has been waiting for a while. In your perspective, and this is, of course, important in today's context, what is the best exit strategy for developing countries with regards to the COVID-19 pandemic, particularly for countries whose debt skyrocketed during this health crisis, which we can theoretically state affect their economic growth in the upcoming years? This is from Alan Okfemia. So what do we do about the debt buildup of emerging economies during the COVID crisis?
So let me talk about at two different levels, what the global community should do, and what individual countries should do. So I think the global community needs to have a debt restructuring facility to enable, you might call a Chapter 11 rapid, recognize this is an unusual situation. In the year 2000, we had the Jubilee and we had debt forgiveness. And it was organized a process of debt, a HIPAA country, highly indebted poor countries, debt forgiveness. We need an initiative like that, which might be called the COVID-19 debt forgiveness program, and recognize that countries that were heavily debt burdened, but manageable before the crisis, clearly many of those debts are not manageable now, and there needs to be a deep restructuring, and it has to be done rapidly. Our experience from the past is that too often there's too little, too late, with enormous deadweight loss. Let me emphasize deadweight loss. Both the creditors and the debtors are worse off